If you look at it big picture, money is man-made. The Fed and the Treasury weren't there when the Big Bang happened, right? It's man-made, it's all controlled. In this video, we're going to talk a little bit more in depth about how it's all controlled. Now, why should you listen to me? I was mentored by the Institute of Trading and Portfolio Management ex-Goldman Sachs traders Anton Creel and Edward Scheck, and the portfolio manager of Dragonstone Capital based out of Singapore, managing $3 billion. In addition to that, I have completed multiple specializations and have also created my own algorithm which is running in the markets, which has generated me over a 7,500% return over the last 15 years, all of which you can find in the bio. The Fed prints money and the Treasury borrows. Liquidity isn't random, it's engineered. First, let me try and give you a broad picture, a broad overview of the underlying mechanics of the Treasury and the banks. So, what happens is that we have this process of quantitative easing and quantitative tightening, where the Treasury can buy assets and inject liquidity in the markets, or sell bonds. By assets, I mean bonds, or sell bonds, take liquidity out of the market and keep it within itself. Now, what happens is that when the Treasury starts buying bonds, they inject money to these banks. The banks, your JP Morgan and your Bank of Americas, these banks now have bigger cash reserves. Now, when they have bigger cash reserves, the interest rate, because they don't really have to protect their cash too much because they're getting an excess of cash. In that case, they don't have to keep the interest rate too high because now they have extra cash. So they keep the interest rates relatively low. In the other case, where when the Treasury sells these bonds to the banks and takes the money out from the banks, that's basically them taking out money from the markets and the banks themselves. The bank's cash reserves decreases. When the bank's cash reserves decreases, what happens then is that they want to protect the cash they have, and that's when interest rates start going up. So quantitative easing and quantitative tightening with rate hikes and rate cuts, it all goes hand in hand. Fed policy, rate cuts, liquidity flows are all front run, and they all know it before you know. And they have a proper understanding of the mechanics behind the market, and they know how to use that information to profit for themselves. What I'm really trying to show you or tell you over here is that there really is a system. This system which is going on behind the scenes. A system which, if you can learn and you can master, you can seriously make a lot of money in this market. Now, in the link in description, I have attached a playbook which contains all market signals and all market indicators which professional traders and hedge funds obsess over. And these indicators are forward-looking and correctly indicate every market crash that has happened since 1955 with a 100% accuracy. Check that playbook out, and just from there you'd actually understand there's so much to learn in the financial markets and there's so much going on.